Hi, welcome to the June 2026 edition of Student of the Market. At THG Retirement Solutions, we break down the noise and provide a clear monthly snapshot of the market so that you can stay informed and focus on what matters most to you. Over the last couple of months, we've talked a lot about staying disciplined through volatility and not letting short-term headlines drive long-term investment decisions. June's update is a great follow-up to that message. As always, the goal is not to just talk about the markets. The goal is to step back, look at the big picture, and ask whether your current investment plan still fits your situation. The best 2 months for U.S. stocks since 2020. We'll start with the strengths in April and May. U.S. stocks were up 16.3% over April and May, making it one of the best 2-month periods for the stock market since 1950. Historically, after the best 2-month periods for U.S. stocks, the following 12 months have averaged a positive return. That does not guarantee what happens next, but it is another reminder of how quickly markets can change. A few months ago, investors were dealing with volatility, geopolitical concerns, election year uncertainty, and a lot of negative headlines. Then, almost just as quickly, the market rebounded. This is why we continue to emphasize discipline. If you try to move in and out of the markets based on short-term fear, you can miss some of the most important recovery periods. Markets can recover faster than people expect, and over the last 5 years, we've seen rapid gains and declines, so staying invested through volatility is often critical. Artificial intelligence and energy stocks. This slide looks at what is driving earnings and performance inside the U.S. market this year. Artificial intelligence stocks and energy-related stocks have been the major contributors. This shows that AI-related companies have seen earnings expectations improve meaningfully this year, while energy has also been a strong performer. That matters because markets are ultimately driven by earnings over time. But it also reminds us that index returns can sometimes hide what is happening underneath the surface. The S&P 500 may be up, but not all parts of the market are contributing equally. You will see on the right, AI stocks and energy stocks are up huge this year, and yet all of the other areas in the market are up only 2% through the end of May. For clients, this is why we want to understand what you actually own. Emerging markets continue to be one of the strongest stories of the year. They are up 50% over the last 12 months. This is the largest emerging market outperformance since 2010. Historically, periods of emerging market outperformance continue for a while, but they are typically also much more volatile. This is another good reminder that diversification is not just owning more assets, it's about owning different types of investments that can lead in different environments. After a long stretch where US stocks dominated, international and emerging markets have added value this year. Midterm elections and US stock drawdowns. We've talked a lot about midterm elections the last several months. As a reminder, when looking at history, they average max drawdowns during the year of negative 20%. And the following returns 1 year later have averaged a positive 32.9%. So there is a ton of volatility. So far in 2026, the market experienced roughly 9% drawdown and is now positive year to date. So remember this important lesson that drawdowns are part of the process. Money market assets and performance. Cash is still a major story. Money market assets have reached about $7.8 trillion, which is a historic high. Cash has felt comfortable because yields have been higher than they have been in many years. But the deck also shows that cash has trailed many diversified bond categories over the last 1 and 3 years. Over the last year, 91% of taxable bond mutual funds and ETFs have outperformed cash. That does not mean that cash is bad. Cash is very important for emergency reserves, near-term spending needs, and liquidity. But for medium to long-term money, sitting in too much cash can create risks that you are not thinking of. If you are holding cash that you don't need for at least a year, reach out to us and we can discuss some great alternative options for you. As we wrap up June, the message this month is pretty straightforward. The markets rebounded strongly. April and May were the best 2-month periods for US stocks since 2020. At the same time, we are still in a midterm election year. Cash levels remain extremely high, and many investors are still trying to determine whether they should stay defensive or put money back to work. For us, the answer is to not chase what just worked. The answer is to have a plan. And at the end of the day, the question is not whether the markets will be higher or lower the next month. The real question is whether your portfolio is still built for your goals, your income needs, and your comfort with risk. If you are nearing retirement or already retired or just want a second look, we'd be glad to help you out. Thank you for watching, and we'll talk again next month.